The United States leads global oil exports, but a new bill could strip away that lead for good. Global energy prices are swinging wildly because of sudden supply increases and recent geopolitical conflicts. For decades, Western nations feared energy shortages, a reality that shaped 20th century geopolitics and drove global power struggles. The 1973 oil crisis hit hard, triggering massive economic instability. OPEC's embargo pushed global prices up nearly 300%, causing widespread fuel shortages. The United States stopped being vulnerable once it rebuilt its entire energy system from scratch. Moving from importing everything to becoming a global powerhouse happened through specific, deliberate policy choices. New technology and policy shifts changed how global power is calculated, altering the math of international influence. Now, lawmakers seeking fast domestic solutions are actively challenging that entire established foundation. Current tensions pit the shale revolution's proven success against a rising wave of new, aggressive, protectionist trade policies that threaten to reshape global energy markets, with oil prices swinging between $74 and $80. Every driver and factory owner faces real costs that impact their bottom line right now. Washington lawmakers proposed banning the United States crude oil exports, a move that would reverse American energy dominance. This move breaks the energy strategy that has guided the country throughout the last 10 years. While some believe keeping oil domestic will lower prices, a ban could choke United States production, punish shale producers, and give more leverage to OPEC. But critics argue this move is self-defeating. A national export ban would choke off United States production, weaken investment, and threaten energy jobs. To see the actual stakes, we must trace our history. The United States was once a victim of the 1973 Arab oil embargo. The country relied heavily on foreign imports to sustain its economy. However, the emergence of horizontal drilling and hydraulic fracturing changed that entire economic reality forever. This supply surge helped the United States move from buying oil to leading the global market. That significant policy change pushed the United States to become the world's top oil exporter, fundamentally altering global energy markets. This shift broke the long-standing power balance previously held by Saudi Arabia and Russia. But this dominance creates domestic pressure. Export surges are draining local inventories faster than we can restock them, creating a real shortage. At the Cushing, Oklahoma oil hub, a critical indicator of supply pressure shows that roughly 400 storage tanks are running nearly empty. Shrinking reserves leave markets vulnerable, so even small supply disruptions trigger sudden, massive price spikes. The United States exports are rising, but recent diplomatic shifts are changing how global trade works. The United States and Iran reached an interim deal, which might end the current Iran war. Traders reacted immediately to the news. Goldman Sachs already cut its Brent crude forecast to 80 following these shifts, reflecting growing market stability. Predicting the future is hard because current production facilities are just too massive. Middle Eastern oil returning to the global market will likely trigger this specific supply glut. This shows why OPEC still matters. Since its Baghdad founding on September 14, 1960, the group has controlled huge portions of the global oil market. About 79% of the world's proven oil reserves sit within OPEC nations, highlighting the organization's massive global influence over energy supplies. This wealth and resource control is exactly what the proposed United States export ban will likely empower. If United States exports stop, the global market loses its primary swing supply. Global stability would hinge entirely on the specific political choices made in Baghdad and Riyadh. Old energy policies and new climate mandates are clashing right now. One era prioritized American energy independence via global trade. Now, a new era is returning, prioritizing domestic protectionism and strict control over resource flows within our own borders. Decisions made this winter will decide if the United States keeps controlling energy markets or loses its leverage to shifting global supply chains. World Health Organization wins. According to energy analysts, OPEC nations gain the most from a United States export ban. By removing American supply from the global market, these nations can more easily manipulate prices to maximize their profit margins. World Health Organization loses. Market experts say United States shale producers lose the most. A ban would destroy their access to high-paying international buyers and stifle the capital investment needed to maintain production levels. What's next? Analysts predict two possible paths within the next 60 days. Either the export ban proposal gains enough legislative momentum to trigger a massive sell-off in energy stocks. The proposal might die in committee, stalled by legislative gridlock. Meanwhile, investors are ignoring the actual risk. A massive supply glut hitting the market in 2027. Gulf Coast refining capacity faces a real crisis. Most American refineries are built specifically to process the light, sweet crude that the United States is currently exporting to other countries. Proposals to ban these exports could choke off United States production and weaken investment. While some believe keeping oil at home would lower costs, an export ban would not deliver cheaper gasoline for American families. If global supply chains break, prices for essential plastics, agricultural fertilizers, and critical medical supplies will likely spike to unprecedented record highs. This economic crash forces European allies to rethink their entire security strategy. Europe spent years changing its energy mix to cut dependence on Russian gas and Middle Eastern oil. Losing American crude in the Atlantic basin forces European refiners to bid against each other for much pricier, heavy oil grades. This competition will likely push global Brent crude prices higher, setting a permanent floor for expensive energy costs. Rerouting global tanker fleets creates logistical chaos, making every single transaction much more expensive and slow. Investors are pulling long-term capital out of the American energy sector. Investors fund billions for new drilling and infrastructure because they expect to reach and sell to global markets. If domestic markets close off, investors will stop funding risky, high-reward shale projects entirely, halting essential energy development. This might erode American drilling tech and destroy the specific competitive advantage that produced today's massive energy surplus, potentially destabilizing the entire domestic energy landscape. This also causes diplomats to lose their leverage during sudden negotiations. Countries have used energy exports to stabilize volatile regions without using military force. When the United States stops this supply, it loses the power to stabilize global prices via market trading. Competitors will likely fill this vacuum, and they care much less about keeping global pricing stable or transparent, potentially leading to increased market volatility. This debate goes beyond mere fluctuations in gas prices. We are deciding if the United States will proactively drive the global energy shift or risk isolating itself within a fragile, localized energy bubble. These restrictions hit midstream operators and pipeline companies hardest. These firms need high-volume throughput to pay off their massive capital expenditures. Stopping outbound shipments suddenly leaves massive pipeline networks empty. This sudden drop in use will crash the market value of energy infrastructure assets, causing widespread economic instability. Lacking these specific grades, refineries will struggle to maintain yields. This drop will likely shrink domestic refining margins across the United States. This change hits the global Brent benchmark immediately. As American light crude supply shrinks, markets must pivot toward heavier, more expensive alternatives to meet demand. Losing the United States as a swing provider removes a critical market stabilizer. Without this essential buffer, sudden supply shocks in other regions will drive global price spikes more directly and unpredictably. A national oil export ban would choke off United States production and give more leverage to OPEC and other hostile producing nations. Should the United States ban gas exports to lower domestic prices, or does global energy leadership matter more? Tell me what you think about this trade-off in the comments. Subscribe and turn on notifications. Next week, I'll explain why European natural gas reserves dropped so suddenly during the recent winter freeze.